My name is Craig Earl, I'm Senior Market Analyst at Oanda, and here we're going to talk about the dollar yen. Now, this is an interesting pair for one reason. We're kind of seeing a battle emerge here between two potentially weak currencies. The dollar looks quite weak right now, it looks quite vulnerable, partially due to the fact that the Federal Reserve, the US Central Bank, has become much more dovish, partially due to the fact that the trade talks between the US and China are progressing very well. And if we remember back a few months when the trade spat was escalating, when we were seeing tariffs imposed, the US dollar did very well out of this. So the fact that we're seeing the reverse happen in the negotiations is why we're seeing the reverse also happen in the currency. So the US dollar looks quite weak right now, but the yen doesn't look particularly strong at this moment in time either. We have seen a nice rebound in risk appetite since the turn of the year, and the yen is typically seen as a risk barometer. In terms of strong risk appetite, the yen tends to underperform. In terms of strong risk aversion, that's when we tend to see a lot more interest in the Japanese yen. But in terms of what we're seeing right now in the chart, we're in this trading band between 108 and 110. A break through 110 would put a lot of pressure on that Ichimoku cloud. The Ichimoku cloud, which separates bullishness from bearishness. A bullish market is indicated by trading above the band, and a bearish market is indicated by trading below. Now, of course, just above we've got 111. We've got a culmination of a number of moving averages right there, 55, 89, 200 and 233 in this particular case, which could offer some resistance. And we'd also be looking for confirmation from that lagging line. However, if we hold below that Ichimoku cloud right now, then I think 108 could come under significant pressure. And one of the things that could potentially trigger that is the fact that we are in a market right now which, yes, since the start of the year has been more bullish. We've seen a strong rebound in equity markets, but people aren't necessarily convinced that this will last. There's a lot of talk out there about the fact that we have seen a strong rebound in US equity indices, for example, in particular, but we still haven't regained the highs from prior to October. And this comes on the back of a much more dovish Fed, of some decent corporate earnings again, and people being less pessimistic about the global economic outlook. So the fact that we're seeing all of these factors line up and the markets are still some way from those highs is making people a little bit nervous that we are going to see another test to the downside. And if we do see that rotation low and we see risk appetite start to dwindle, that could benefit the yen and potentially be what rotates this pair lower and potentially through that 108. If we see a break of 108, then those 105s I think could be quite interesting. Not just because we touched it in the most recent flash spike in the Japanese yen itself, but this is a historic level of support and resistance. So a rotation through 108, yes, there's a big gap from 108 through 105, and there's going to be potential for support and resistance along the way, but a breakthrough 108 for me puts the focus on 105. Again, that's not to say that we will necessarily reach those levels, but that for me is the next major level of support for this pair. That for me is the next major test for this pair. On the flip side of that, if we do go through 110, we go through that 111, then we're looking back towards the upper end of those previous trading ranges. But again, when we're seeing a battle of two very weak currencies, those moves may take time to materialize. And the reason why I think the move lower below could materialize that little bit quicker is if we see risk appetite in the market dramatically shift, which gives the impetus to the Japanese yen. The flip side of that, the thing that could potentially lead to a shift in impetus in the US dollar, I think would be to do with those trade talks with China. I don't think the Fed is going to become suddenly more hawkish. I don't think that the economic data is suddenly going to become fantastic once again. If talks between the US and China break down and we start to see the potential for more tariffs in 4 weeks' time, when the current 90-day period expires, then we could potentially see that fear transition into US dollar strength. But for now, that's not looking likely. That's not looking like something that the market's anticipating, and I think this is a market that is factoring in US dollar weakness.